love the channel and find it useful in becoming a happy retiree. Subscribe today. We're going to start with Jeff, who joins us from Marietta. Jeff, good morning. Welcome to Money Matters. What's going on? How can we help, man?
Yeah, you posed the question, is your 401k keeping up with, say, the S&P? And I'm looking at mine, and it's around 7%, and yes, I see it going to 12, the S&P going to 12, and you start thinking, okay, has my financial advisor got me into things that I need to be in? And I think you just answered my question with all the markets and the variability there probably averages out to about 7%, if I, just in my head, what you just said.
Well, it depends. So again, Jeff, this is something that I would say for the most part, I'd say that this is agreed upon. And there's plenty of studies that show this, that your overall, the asset allocation, which is the mix between stocks and bonds and U.S. and international, and cash, that leads you about 90% of the way to where you're going to end up any given year, right? If you have one large cap money manager or index or even hedge fund, and large caps do really well, all three of them are going to do pretty darn well. Now, one might be up 20%, another might be 25%, but they're going to be in the same range. Right. And I think what's happening here, and if I look at, what is your what's your percentage of stocks versus bonds? Let's start real simply.
80-20.
80% in stocks.
Yeah.
So not a whole lot on the bond side. And then I would suspect then within that 80%, which is the majority of the portfolio, how is that parsed out?
I don't have I'm in my car, but I just looked at it the other day, and I know I'm.
Oh, you don't know Jeff, you don't know the exact percentage down to the 10th of a basis point where your large, mid, small, international, emerging market 401k is? My goodness, let's get right with the new year, my friend. So of course,
I have it. It's just not in front of me.
No, I'm kidding. So that's rare that an investor would be able to pull that out. But here's so the numbers there's a big enough disparity between what the U.S. market did and what international did that would lead me to believe pretty simply that you probably are almost half in international. Oh, and I say that because if you remember, U.S. 12% on the S&P at 500, so that's the large cap category. Small and mid cap companies were up 26% and 21%. That's a big disparity between seven. You've got to have some major weighting towards these international companies to be able to get down to a 7. So that all country world index is up 4. And that, if you do the math between 12 and 4, then you've got to have around a half of your investments in international to be able to get down to a number only 7% in a year like we just had. So my thought here is look at this and say, well, okay, I go back to my advisor and I say, look, I understand that we need to be invested all over the globe. That makes sense to me. And my philosophy, Jeff, has been that particularly in the last decade, U.S. companies are all already very exposed to the rest of the world. We know that 50% of revenue and more than 50% of profits in some cases for big S&P 500 companies and even mid-cap and small caps, it's because they're selling in 30, 40, 50 different countries outside of the United States. So just because you own a U.S. company, by no means, particularly today versus 10 and 20 years ago, by no means does that isolate you from economies in the rest of the world. So the requirement for us to have 20% in Europe and 20% in Asia, specific countries and companies in those countries, I don't know if that needs to be that. Now, I will tell you that over the last, right now, if you look at Europe, their demographics are a mess. So I am leery to have companies and have a whole lot of exposure to international right now. And that might change in a year from now, but for the next 6 to 12 months, it's hard for me to get excited about international investing. Now, it doesn't mean that at some point those countries don't turn around. It's just going to take a lot. So what I would do, here's my task for you. I would just go ask. I'd say, hey, guys, I've obviously got a big chunk that's invested international, probably 30 to 50%. What's the justification for that? Why are we doing that? Is this going to turn around? Are the companies inside, or the funds, or the ETFs that we're using, is there some sort of catalyst we're thinking about over the next couple of years? Or is this just a model that your computer spit out and said, oh, you're 30 and you're an aggressive investor, you should be half US, half international? And if that's the case, Jeff, then I would look around, and you may want to look at another advisory team, because they're just sticking you in some computer generated modeled over the last 40 years of investing returns or investment returns. And I don't know how relevant that is or how much it makes sense. As an example to that, I looked at different financial planning software in this past year. And one of the models I looked at has what I think are the most ridiculous assumptions for their rates of returns moving forward. Their balanced portfolio, let's say, was half bonds, half stocks. And because bonds in the last 30 years have averaged 6.5%, their balanced half bond, half stock model over the next 20 years, their forecast was it to be up 9 or 10% for a half bond, half stock portfolio, because bonds have done well in the last 20 years. That's just wrong. It's just egregiously wrong. So just looking back and seeing what bonds did over the last 30 years, that assumption over the next 10 could be just ridiculously wrong. And I think a lot of financial institutions still rely on that historical data.
Well,
and
my advisor, when the first plan came through, was 10%, and we're not. And I started investing in 2000. Of course, I've been through a lot of ups and downs, but we're not getting there. And I'm 17 years in. I'm 43. I've got some years to go, but it's just it's a little frustrating. You think, okay, is my money with the right person?
Well, I'm not saying it's not, but I would have them answer that pretty specific question. Hey guys, why are we 50% in these international companies? And if that's the case, what are we going to do about it? And that would be my first step. If there's not a good justification or a good answer, then yes, I think it's time for you to start shopping around. And it sounds like you've been patient, Jeff. But I think you're smart to at least question where you're headed, and this is your future. And I think it's important to stay on top of it like you are. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.